Okay, by now you should have completed your Chapter 1 homework and you're ready for Chapter 2. Chapter 2 is on the balance sheet, and we're going to first discuss limitations of the balance sheet or functions of the balance sheet. First thing is that it's a snapshot in time. So the theory is that at the end of a period, say December 31st, we go ahead, we count everything we have. And then January 1st, when we open up, if we go ahead and we buy supplies or we go ahead and get a sale, the balance sheet's no longer accurate. So it's just a theoretical snapshot in time, and I say that because sometimes it takes months for companies to develop their balance sheet for a period end. It does not reflect a lot of values to hospitality. As an example, those qualitative factors, if you have a great management team or you've got a unique location or you have recipes that you're known for, those aren't valuated in a balance sheet. And then finally, accounts are not accurate or exact. An example of that would be inventory. If you think about your own personal inventory, I'm sure there's been times where you've thought you had chicken or steak in your freezer, or you had chicken or steak in your freezer that you counted in your inventory. You went grocery shopping planning on using them. You go to your freezer to pull them out and they're freezer burned, and they're not worth anything. So you had a value on that on your balance sheet, if you will, but those items aren't any good. In a restaurant, we could count a case of lettuce as an example, and then when we go to use it, we find out that a third of the heads of the lettuce are not usable, so we miscounted our inventory. So accounts are not exact, or they're not accurate. As an overview, we talked about this in Chapter 1. We've got assets, we've got liabilities, and owner's equity as far as the three accounts on a balance sheet. The assets or the current assets are listed in the order of liquidity, and we'll go ahead and talk about that. And then the non-current assets are often called PP and E because it's property, plant, and equipment. If we have any other assets, we could have investments, and those investments actually could be short-term or current or non-current. It just kind of depends on what our use is. That's something that we're going to know personally, so it's not a matter of guessing. It's funny how it is when we learn accounting in school that we're told these things, or we're told we're not told, and we need to figure it out. If it was your company and you had assets, if you went ahead and had money that you were saving for, let's say, a building expansion or a piece of equipment, and you wanted to earn a little bit of money on it over the next 6 months, so you put it in investments, that would be non-current because you planned on using it in the current period or the current accounting cycle or the current year. Whereas if you had money that you had investments that you planned on leaving there for a number of years, it would be non-current. All right, so again, assets equal liabilities plus owner's equity, and we talked about that in Chapter 1. The asset is what we have, and the liability and owner's equity is the claim on that asset, so who actually owns that asset, the bank or creditors or ourselves. And then we have current accounts versus non-current accounts. The difference between a current account and a long-term asset or a non-current account is a year or a normal operating cycle. In our industry, it's 12 months or a year. It's not the normal operating cycle. In other industries, because it takes a long time, as an example, shipbuilding or even building skyscrapers and such, it could take 2 or 3 years to build something like that. So their normal operating cycle is going to be the time it takes to construct that building or build that ship. But for us, it's a year. Again, current assets are listed in the order of liquidity, with cash being the most liquid, of course, and then marketable securities, which is almost a cash equivalent, being second, and then accounts receivable and on down, and we'll cover that in a minute. And then we have contra accounts. There's actually 3 common contra accounts that you'll need to know. One is allowance for doubtful accounts, and that's a contra account for accounts receivable. We estimate how much of the money that we're owed in accounts receivable that we will not receive, and we make an allowance for that. So that is actually deducted from accounts receivable. Then we have depreciation, and that's a contra account for our PP and E, or our plant, property, and equipment, our long-term assets. And then finally we have treasury stock. And what happens is we issue common stock And then companies go ahead and buy back that common stock to gain more ownership of the company. When they buy it back, it's on the balance sheet in the form of treasury stock. So treasury stock is a contra stock account. Okay, typical components of current assets. Again, I talked about marketable securities as being a cash equivalent. So we start out with cash, then marketable securities, and then accounts receivable and inventories. And then we have amounts due from owners or management company related parties. So that could actually be something in the form of income taxes payable if we're getting income taxes back within the next year. And then we have prepaid expenses, and that would be like prepaid insurance. Usually we pay insurance a year at a time, so we'll have a current asset account of prepaid insurance. And then we have current liabilities, and that could be any of these items that I have up here. The most common are notes payable, accrued expenses, income taxes payable, or deferred income taxes. And then finally, we have current maturities of long-term debt. What happens is if you think about a mortgage could be 30 years. However, 1 year of that we have to pay, or 1 year of that we're going to pay this year. So we move that year of the mortgage up into the current liability section of our balance sheet. If we had to figure out how much we owed on that mortgage, we'd have to go ahead and actually add the current maturity of the mortgage with the long-term mortgage, or the mortgage component that's in the long-term liability section. And then we have non-current assets, and again, we talked about investments that should be not if, more than 1 year or a normal operating cycle. And then we have property, which is land, plant, which is equipment, and our building. So property, plant, and equipment. I guess building is the plant, I'm sorry. And then we have the depreciation of the above. And what that is that's that contra account that we talked about for our PP&E, or for our land, building, and equipment. And then non-current liabilities would be the non-current portion of our mortgage, or if we have a notes payable or a long-term debt, that's going to be non-current. Finally, we have owner's equity, and if you see I have corporate in parentheses, because if we have a proprietorship, the owner's equity is just going to be like Jim Taylor Capital, and there would be a number there. So it's almost all retained earnings, because we don't have stocks and bonds and treasury stocks in a proprietorship or a partnership. So stocks we could have preferred or common, and we're going to actually talk about stocks a little bit more when we do the homework, because we have a paid-in capital in excess of par, which some of you will remember and some of you won't. The one thing I will let you know is that a lot of the homework, even though it's a review, you're probably going to look at some of the problems and not remember the answers, and you may have to look them up in the book, and that's fine. My reasoning for going over these chapters is just to get us up to speed and to get you all thinking in accounting terms. And I really don't expect you to remember everything from previous chapters. Then we have bonds, and what a bond really is when a company borrows money from us. So a company can raise money in one of two ways. They can either go ahead and sell part of their ownership in the form of stocks, or they can go ahead and borrow money from us in the form of bonds. And then we have treasury stock, and like I told you before, treasury stock is a contra account for our stock accounts. So treasury stock actually has a negative balance on the balance sheet, as does allowance for doubtful accounts and depreciation. And then finally, hopefully, we have retained earnings, and that's the money that we've earned in past periods that we chose to reinvest in our company and not pay in dividends. And some companies have pretty large retained earnings accounts. Apple, they talk about their retained earnings being in the billions, as an example. Okay, so that was Chapter 2. You should be ready for your homework, and we'll talk again for Chapter 3.